Hello everyone, welcome to Akira's Academy of Accounting and Finance, and today we are going to talk about how the companies will issue their shares for the public, for the investors. Okay, now that issue of shares could be at par, at premium, or at discount. Now what are these terminologies? Let me explain you. Now first you need to understand certain terminologies like nominal value. What is nominal value? The face value of shares, the value being mentioned on the share certificate. What is the value of that particular share? Okay, that is the face value, nominal value. Then comes issue price. Issue price is what, at what price the company is issuing their shares in the market, at what price they are selling their shares in the market, offering it to the public for investing. Okay, and then there is a market price, MP. Market price is what? Market price is after issuing the shares are listed, okay, on the stock exchange, and now they are being traded by the people. They buy and sell the shares based on demand and supply. The market price will fluctuate. Okay, nominal value, it's not going to change. Nominal value is the face value of the shares. Issue price will also remain the same. It is not going to change. Issue price is the price at which they are offering their shares to the public to invest in their company. Now right now, the shares follow the book building method. What is book building method? It's a kind of a bandwidth which is allowed, okay, and based on the requirements, based on investors, they decide the price at which they will issue the shares. Okay, that is a bandwidth book building method which you will learn about it later. Okay, but that is based on that they will determine the price at which the shares will be offered to the public during IPO or during follow-on public offering. Okay, so that is the issue price. Now when they issue the shares to the public, it could be at par. What do we mean by par? Par means the shares are being issued at their nominal value, that is at their face value, or else they can issue the shares at premium. Now what is premium? Premium means over and above the value of the face value of shares. Okay, there are certain companies which have certain name and fame in the market, and when they come for public offering, they those companies have a certain name. They don't issue their shares at their nominal value, face value. Okay, this is the initial price which they decided when they will come up with this company form of structure. Now the demand of that company is so much high, and based on their demands and all these things, they will issue the price. Let's say there are three companies which I have mentioned. LIC, Life Insurance Corporation of India, you know about it. Their nominal value is 10 rupees. Their issue price, the first time then they issue, the issue price was 949 rupees. So this 939 is what is the premium amount. They charged that much amount of premium from the public. Their nominal value was just 10 rupees, but their issue price 949, that is 939 was the premium amount, and currently their market price is 423 rupees 70 paisa. So this will change. This can go high, it can go very low based on the market. Okay, based on the demand and supply of all the investors. Okay, so their market price is 423. Now you all know Zomato's nominal value was just rupee 1 and its issue price was 76, and currently its market value is 330. Now see the jump from 76, the issue price was 76, and now its market value is 330. So you can't predict the market. It can go as high as possible, it can go as low as possible. Okay, you really need to understand the market. Fine. So the premium amount for Zomato was 75 rupees. At 1 rupee was their nominal value and the issue price was 76. So the premium amount was 75 rupees. And then Paytm, that also you know, right? Paytm's nominal value 1 rupee, but Paytm issue price 2150 rupees. So 2149 was what? It was their premium amount, right? And right now, currently, the market value is 1640 rupees. Okay, 10 paisa. So, like that, the market can go up, the market can go down. Okay, so this is how the market works, that you will study later, but this is what is the premium amount. Right now we want to discuss about the premium amount. So this is called the premium amount, the securities premium. So the shares can be issued at par or at premium. Okay, so what is it called? It is called securities premium. This thing is called securities premium. Okay, and this securities premium, when the company receive the security premium, where they will show, I hope you remember we prepared the balance sheet, then equity and liabilities. Under that there was shareholders fund. Under that we will show the reserves and surplus. Under equity and liabilities there's a subheading called reserves and surplus, wherein we are going to show this security premium amount. Okay, under this heading we are going to show the securities premium amount. Now this premium amount, for what purpose they will use this premium amount? So the first situation could be to issue the fully paid bonus shares. Bonus shares means what? Bonus. Okay, at no extra cost they issue the shares to the public. Okay, so that is bonus. They give bonus share instead of giving dividend. Okay, they thought of giving the bonus shares, issuing the bonus shares. Second situation could be that to write off the preliminary expenses. Now what is preliminary expenses? Prior to incorporation, whatever expenses they have incurred, let's say they have paid certain legal fees or stamp duty, for this memorandum of association or article of association, or to the registrar of companies, or they have made certain printing expenses, okay, for this memorandum and article to prepare, them incurred certain printing expenses. So all these things are known as preliminary expenses. Like before the company started its operation officially, whatever expenses they have incurred is called preliminary expenses, and to write off that preliminary expenses they can use the security premium amount. Okay, the third situation could be to write off the expenses. Which expenses? Commission paid or discount allowed. On what? On any securities, on issue of any shares and debentures. What are debentures? That also I will teach you, but these are called securities shares. It could be equity shares, it could be preference shares, or it could be debentures. When they are issuing those shares and debentures, they are paying certain commission to certain public or to certain people, or when they are allowing certain discount amount. So to write off these expenses they can use this premium amount. The fourth could be to pay premium on the redemption of preference shares and debentures. Redemption means to redeem. Redeem means when we pay, give the money, when we just write off this preference shares amount and debentures, we pay off the money to the shareholders or to the debentures holders. So when you are paying the money to the shareholders, preference shareholders or debenture holders, and you are paying any premium amount on that, any premium amount, remember. So to pay the premium, only the premium amount on the redemption of preference shares and debentures. And the last is buyback of shares. When they purchase their own shares, we are going to discuss about the buyback of shares and all these things, but when they purchase their own shares they use this security premium amount. So the securities premium amount will only and only be used in these situations, in these 5. Under Companies Act 9 2013 they can use the security premium amount to write off all these expenses for nothing else. Okay, I hope now you know what is security premium. Now this was a book building method. We are not going to discuss the book building method. We are going to discuss about the fixed price method. The one application money, there's an allotment money, there is installments called during the first call or second call. In our example, like we discussed about 4 rupees was the application, 3 rupees allotment, 2 rupees first call, and 1 rupee was second call. This is how they called the amount in installment from the public. So when they are asking from the premium amount, they can ask at the time of application. Usually they ask during the time of allotment. Okay, usually most of the time they ask for allotment, and rarely during first call and second call. Okay, now in this example, the nominal value is how much? It is 10 rupees. Fine, this is 10 rupees, and they said that they will ask for 2% premium amount. 2% means on, not 2%, let's say 20%. 20% premium amount. 20% means on 100 rupees they are asking 20 rupees. So for 10 rupees it will be how much? So 20% of 10 is how much? 2 rupees. So 2 rupees is the premium amount the company is demanding from the public. So they can include this 2 rupees at the time of allotment plus 2. Okay, so the allotment money they will ask for is rupees 5, which includes the premium amount. Okay, so let's say if they ask for application during the time of application, we'll take it later. Let's say they ask during the time of application 2 rupees. So the application amount is how much? 6 rupees. So what will be the entry for that? In our situation there were 60,000 shares fully subscribed. Okay, fully subscribed 60,000 shares. So the entry will be bank account debit to equity share application account. How much will be the amount? 60,000 into 6. 6 is the 3,60,000. Okay, during the time of application they asked for this money, and all the shares were fully subscribed. They paid 6 rupees at the time of application itself. Now this 2 rupees is what? Is the security premium amount. So it will go securities premium account. Okay, now we will close this application account. So the second entry will be equity share application account debit 3,60,000. Now what will come? To equity share capital account. We need to close this application account. We need to transfer the money only and only in capital account. How much money we will transfer? What is the value during the time of application? The face value is 4 rupees. 4 into 60,000, that is in capital account. How much amount will go? 2,40,000. And what about the remaining 2 rupees? 2 into 60,000, that is 1,20,000. Where it will go? It will go under securities premium account. Okay, so this will be the entry when they are asking for money at the time of application. Remaining entries will be the same when they allot the share. The allotment money, first it will become due. So equity share allotment account debit to equity share capital account, and then they will receive the money for allotment, that is bank account debit to equity share allotment account. Equity share allotment account will get closed. If at all, I will just pass the entry, right? Equity share allotment account debit, how much? 3 rupees. Okay, 3 into 60,000, 6 3s are 1,80,000 to equity share capital account 1,80,000, and this they will receive. So the entry will be bank account debit 180 to equity share allotment account 180. And for rupees 2 and for rupees 1, the first call allotment amount will become due. So first it will become due, and then they will receive the first call amount. Second and final call, try to remember. So the final call amount, first it will become due, and then they will receive that amount. Okay, so this is how you will pass the journal entry when the application, when they are receiving the premium amount at the time of application. But let's say they are not receiving this at the time of application, they are receiving it at the time of allotment, 2 rupees. So allotment, how much they will ask? 5 rupees. Fine, 2 rupees will get add on to the allotment amount. Application, they are asking that particular face value only during the time of application. What will be the entry? First they will receive the application, so bank account debit 2,40,000. Okay, this is the application amount they received to equity share application account. Equity share application account, we need to close it. Equity share application account debit 2,40,000 to equity share capital 240. This entry will not come. Okay, because they are not asking for the premium amount at the time of application. Okay, when they are asking for the securities premium amount at the time of allotment, they are asking for 2 rupees at the time of allotment. So instead of this entry, what will be the entry? Equity share, first the allotment money will become due, account debit. How much amount will become due? 5 rupees. Okay, 5 into 60,000, 5 rupees will become due, 563 lakhs to equity share capital account. Capital amount, how much it will get credit? Capital amount only with the allotment money due. 60 into 3, that is 1,80,000, and remaining 120 they will credit to securities premium account, 1,20,000. Okay, 2 into 60. So this is how they will pass, and then they will receive the allotment money. So here it will equity share bank account debit 3 lakh to equity share allotment account. Allotment account will get closed and the entry will be 3 lakh. So this is how they are going to pass the journal entries. For first call amount first will become due, then they will receive the money. Second call amount will become due, and then they will receive the money. It may so happen that they call at the time of first call or at the time of second call, and this is how, instead of equity share allotment account, here it will come first call account and the amount will get transferred to the securities premium account. Easy, simple to understand. So this was when they issue the shares at premium amount. But it may so happen that they issue the shares at discount. Now it is not allowed. Okay, discount means less price as compared to the nominal value, as compared to the face value. Now this situation is not allowed. The company can't issue the shares for IPO at discount. There are only 2 and 2 situations when the company is allowed to issue the shares at discount as per the Companies Act. What are these 2 situations? When they reissue the forfeited shares. What is forfeited shares? We are going to study about the forfeiture of shares and reissue of forfeitures of shares, but just a simple idea. You studied, okay, in first call and second call in the previous example, that there was one shareholder who didn't pay the money during the second and final call, right? So when they are not paying the money, they are given certain time to pay off the money. Still, if they don't pay the money, their shares get forfeited, zapt. Okay, in Hindi. So their shares get forfeited. Now they will not ask money from that shareholder, and then what they will do? They forfeit the shares. Now they can reissue the shares to somebody else, for the public to, they can reissue that forfeited shares. And when they are reissuing that forfeited shares, they can reissue it at a discount, at a less amount. And the second situation is when they issue the sweat equity shares. Sweat equity shares, okay, who give their sweat to the company. Okay, who give their sweat? The employees, okay, the workers, the directors, okay, they are the one who put their blood and sweat for the company. So for them, the company issue the sweat equity shares, and then they can issue the sweat equity shares at discount. Okay, so these are the two situations when they can issue the shares at discount. Issue of sweat equity shares, I will just briefly explain you all certain terminologies like buyback of shares, issue of sweat equity shares later in the chapter when we go through it, but this is what the basic thing is. So the company can issue the shares at par, at premium, or at discount. Par, face value, nominal value 10 rupees in this situation. Premium, over and above the nominal value, 10 rupees share issued at a premium of 2 rupees, that is 12 rupees. So 2 rupees is the premium amount. It will go under securities premium under the head reserves and surplus. Okay, under equity and liabilities, reserves and surplus, it will come as a security premium amount. Security premium amount can be used for this 5 situations only, for nothing else. They can't just give dividend from the premium amount to their shareholders. Okay, like they can't use for any other purpose except for these things. Or they can issue the shares at discount. Issue the shares at discount only and only when they are reissuing the forfeited shares or when they are issuing the sweat equity shares, not during IPO or FPO. Okay, understood. Now we will discuss about issue of shares for consideration other than cash. Here we were demanding cash from the public. The company was demanding cash money from the public. But there are situations when they are issuing the shares for other than cash. Now what is other than cash? They are not asking for money from somebody. Let's say a company need a certain machinery. Okay, they need a machinery. They went to that vendor, buy that particular machinery, and instead of giving cash to that particular vendor, what they issue? They issue the shares. Okay, let's say the machinery. Now there is one thing that they can issue that shares, same shares at par or at premium. Okay, it's not necessary that they issue only at par or they can issue only at premium amount. Okay, so how you will determine the value of the premium amount, that we are going to discuss. Let me just erase it and I will tell you. Okay, now let's say the company wanted a machinery. The value of machinery is how much? Machinery's value is 5 lakh. Okay, and the issue price is how much? Issue price is 100 rupees. So how many shares they are issuing to that particular vendor? The value of the machinery divided by the issue price. Okay, divided by the issue price, not at the nominal price. Okay, issue price, at what price their shares are issuing. Okay, so how much it will be? 2 zeros gone, that is 5,000 shares. They are giving how many shares to the vendor? 5,000 shares. Now what will be the entry? The first entry will be the machinery comes into the business. Machinery account debit, it is an asset. Okay, I hope you remember the rules of debit and credit, modern as well as traditional. To vendors account, 5 lakh, and they are issuing the shares to the vendor. So now the vendor account will get closed. Vendor account debit to equity share capital account, 5 lakh. Okay, but let's say they are issuing the shares at a premium amount. Now the premium amount, let's say, is 125, that is 25%. At 25% the premium amount they are charging from that particular vendor. So what is the issue price? Issue price is 125. So how many shares they are issuing to that shareholder? This is the price of the machinery. 5 lakh rupees is the price of the machinery. And what is the issue price? Value of machinery divided by the issue price. 5 lakh divided by 125. How much it will be? 125. 125 and 4 125 are 500. Okay, so how many shares they are issuing? 4,000 shares they are issuing to the vendor. Okay, now what will be the entry? Same, machinery account debit to vendor account. They are purchasing a machinery at that price 5 lakh. Vendor account debit 5 lakh. How much it will go to share capital? The shares issued are 4,000. Okay, and what is their nominal value? 100 rupees. So how much amount will go? 4 lakhs. Remaining 1 lakh, it will go to securities premium account. Okay, 4,000 shares into 25, that is 1 lakh will go to securities premium account. So this way we are going to determine how much will go to the capital account and how much it will go to the securities premium account, and how it will be calculated. I hope you got it. How the shares are issued: it can be issued at par, at premium, in certain situation at discount, or they can issue the shares for consideration other than cash. I hope you got it. Practice a lot, and next time we are going to discuss a lot more about shares: over subscription, under subscription, forfeiture of shares, reissue of forfeited shares, and certain more terminologies. Thank you very much.